Hello, everyone. Welcome to Scope's Portfolio Management Conference session. My name is Manqing, mutual fund analyst from Scope Analysis. It is my pleasure today to have Colin Finlayson, portfolio manager from Aegon Asset Management, here with me in the session. Welcome, Colin.
Hi, thank you. Thanks for having me on.
Colin is a bond fund manager. Now, 2020 was a good year for bond prices and for investors who seek to use bonds to preserve their capital. Thanks to central banks' rate cuts, asset purchases, and special facilities, returns for all major fixed income asset classes were positive, with interest rates very likely to remain ultra low and inflation weak. What should bond investors expect in 2021 against the backdrop of uneven post-pandemic economy recoveries worldwide? Please join us with Colin Finlayson, co-manager of Aegon Global Strategic Bond Fund, sharing his view on the fixed income landscape in the new year of 2021 and why investors should target multiple sources of alpha using a strategic bond fund. Meanwhile, if you have any questions during the meeting, please write down your message on the right bar. We will either answer them directly if time permits or reach out to you with more details after the meeting. You could also replay the full clip on our Scope Explorer platform. Now, as always, let's start with some questions on the team. Colin, first tell us about yourself. What is your industry background and relevant to the bond strategy?
Yeah, hi, and yeah, thank you for taking the time to have me on today. It's much appreciated. Yes, my background is I've been in the industry for just a little over 20 years. I've spent all of that time with Aegon Asset Management as part of their fixed income team. My background is more in sort of macroeconomics, and I've been involved in our sovereign research team for all of that 20 years that I've been with Aegon. I managed global government bond portfolios for about the first 10 years of my career. And then for the last 10 years or so, I've been managing more sort of flexible or unconstrained portfolios, such as the Strategic Bond Fund that we're going to be talking about today, and also the Absolute Return Bond Fund that we run at Aegon Asset Management.
Mm-hmm. So let's talk about your co-manager, Alexander Potashis. What's his background? How do you divide work in the team?
Yeah, Alex joined the business in 2014. He came from a sort of credit research background from a variety of different investment banks, and his area of specialism is in financials, particularly banks. So when we are working together, there's I guess there's kind of a natural split in terms of our areas of specialism. Alex is very much involved in the corporate bond market, whereas my background is more on government bonds. So we tend to kind of split responsibilities more in that way in terms of individual position taking. But where we do work together is, things like decisions on asset allocation and portfolio shape. So it's very much a collaborative approach, but we do have our areas of specialism.
Great. So apart from a clear defined role between the co-managers, if we look at the overall research capacity of the whole team, how many analysts are supporting the strategy right now, and what roles do they play? Does the team work more independently or collaborative within the in-house network?
Yeah, no, that's a really good question. The portfolio management team here is embedded within the existing fixed income team at Aegon Asset Management. So we're benefiting from the overall investment process, which has been in place for, for almost 2 decades now. And actually, if you look on slide 2 of the presentation, you can see there the resource that we have on the fixed income team at Aegon Asset Management on a global level. So you can see on the bottom left-hand box there, you can see that we have over 50 research professionals who are looking at individual parts of the market, different sectors, different government bond markets. Alongside that, we've got over 70 different investment professionals or portfolio managers who are also managing a variety of different strategies that we can take advantage of. So we like to think of our strategic bond fund as sitting at the center of a lot of what our fixed income team does, taking on board ideas from the different portfolio managers, but crucially from that research team that are looking to generate sort of bottom-up stock ideas, that many of which do find their way into the portfolio. So it's not just myself and Alex. There is a large and very experienced team there to help back us to to help generate ideas for the fund.
Mm-hmm. So in terms of work style, the team works interactively to leverage Aegon's platform. Now let's move on to the fund. First of all, a question on behalf of all our investors. What is a strategic bond fund? How does it differ from traditional bond fund products?
Yeah, a strategic bond funds, I guess, is think of it as being like a flexible or unconstrained fixed income fund. And what that means is they're able to invest across the full fixed income universe to identify the best opportunities, wherever they may be. So that can be in different asset classes, or it can be investing globally. So the real difference between a strategic bond fund and other sort of more traditional bond funds is that ability to look at not just say government bonds, but also look at corporate bonds, and also look more globally. So it's almost as if we have more levers to pull on and a more flexibility to generate returns, more so than you would have if you're within a single asset class portfolio. So essentially that's what it is. So strategic bond funds, and you can see on slide 3, they're essentially, they are funds that are like what you'd see if when you think about unconstrained or flexible fixed income funds.
Mm-hmm. So the highlight of strategic bond fund is actually it could cover a very dynamic and blend of exposure across the entire range of fixed income market, which makes a decision on the investment universe extremely important. And how does the investment universe look like for your strategy, and what is the philosophy?
Yeah, as I said, the investment universe is very broad in terms of that whole fixed income markets. We've got a very clear idea as to what we think we will buy for this fund and what's appropriate, and crucially what isn't. And you can see that on page 4 of the presentation in terms of the opportunity set that we have. So we can and do invest in everything from government bonds through to investment grade corporate bonds, high yield, emerging markets, and some areas of sort of asset-backed securities. So we have a high degree of flexibility in terms of what we can invest in. What we will not invest in is any other asset classes. So we don't invest in any equities, which sometimes find their way into bond funds, which is something we don't believe in. Also, importantly, we don't take any active currency risk within the portfolio. So every asset we invest in, which isn't denominated in our base currency, we hedge out that foreign currency risk. So you're just focused on the fixed income based risks and returns. And then within that, our preference is to invest in the more liquid and tradable parts of the bond market. This is a fund which investors can buy and sell on a daily basis. Therefore, liquidity is something that is very, very important to what we do. So we don't go to seek out opportunities from buying illiquid assets and gaining that illiquidity premium. Instead, preferring to invest in those assets that are more easy to buy and sell. And I think that's what helps us when we want to take our, sort of more active approach and a more dynamic approach. And that's the kind of philosophy of the fund, is that there is a number of opportunities out there, and we want to be actively seeking out the best opportunities, wherever they might be, and then switching into a new one where we think that is appropriate. So yes, there is a wide remit, and the opportunity set in many cases is very, very broad. But we have a very clear idea within that what we think is appropriate for this type of fund, and have a lot of flexibility in how we will allocate between different parts of the market.
Mm-hmm. So speaking of the approach, the fund marries top-down with bottom-up drivers. How do you decide, for example, on the allocation and duration, and what are the screening criteria for credit selection? And essentially, what are the main common traits for your conviction? And could you kindly walk us through the investment process?
Yeah, sure. Yes, sir. As you say, our investment process is a mixture of top-down and bottom-up factors that we will look at. The investment process really begins with an assessment of the macroeconomic background to see what that means for the direction of government bond markets. Do we think yields will be higher or lower over the investable horizon that we are looking at? Once we've decided on that helps inform the level of interest rate risk that we think is appropriate, or how much duration we should have. So currently within the fund, we think yields have been trending higher, so you want to have slightly less duration in the fund than we may have had at times last year. And then we can decide where we want to take that interest rate risk in the fund. How much comes from the US, Europe, Japan, Australia, whichever markets we were looking at. Then the next step down is on asset allocation. We're looking to determine how much of the fund we'd want to invest in government bonds compared to corporate bonds. And then within that, how much of that corporate bond exposure will be within investment grade, how much of that will be in high yield, and how much will be emerging markets. So this is something that we develop and work within our fixed income team, with the members that we have based in Europe and in the US. So it is an established investment process that we have within Aegon Asset Management. We then take another step down to determine, once we've established the allocation for these different asset classes, we then will look to populate that with individual bonds that we think are most appropriate for the portfolio, and that's where the sort of bottom up part of the process comes in. And as I mentioned, the 50 investment professionals we have are there to help us identify those individual opportunities that we have. But it's quite a dynamic approach that we have. And if you see on page 5 of the presentation, you can kind of see how this is just one example of how the process works in action. Being how we allocate between these different asset classes and how that changes over time. So coming out of this process that we have, we're looking at these different asset classes and trying to see, from a risk-adjusted point of view, where should we be allocating the capital in the fund. Should that be more in government bonds? Will it be investment grade, high yield, etc.? But it is a very dynamic approach. We review this formally on a monthly basis. In reality, we are looking to make changes in the fund whenever that might be needed. So that could be on a daily basis or a weekly basis. But it is that combination of both top-down and bottom-up factors that really helps drive returns. And that has been crucial during the last 12 months, and it will be even more important in the next 12 months.
Mm-hmm. We got a question from the audience regarding the liquidity you were talking. Is liquidity or lack thereof in this case your reason not to invest in private placement? And the second question is, you put great emphasis on liquidity. Is this emphasis based on a high drawdown risk?
The two very good questions. Yes, private placements are inherently less liquid than publicly traded assets. So that is a big part of the reason why we would choose not to invest in them. Whilst you may get they may come at a slightly cheaper level, and you may benefit from investing in a private placement, then your ability to then sell those assets and recycle into something else can be more difficult. What we don't want in this portfolio is to have a meaningful allocation into assets which we can't sell and are illiquid. And private placements are something that I would be concerned about in terms of the liquidity. The focus on liquidity isn't being driven by fears of a drawdown. It is just a fact that when you have a fund that's priced on a daily basis, you have to be able to buy and sell your assets in a relatively short period of time, because you never really know from day to day what's going to be happening with the fund. But the other sort of factor here is just the approach that we take, the active and dynamic approach to investing, means that we want to be able to switch from buying Italian banks on one day, and then we want to be able to sell them and maybe buy some Spanish banks, or we maybe want to shift our interest rate risk in the funds. We want to focus on government bond markets that are more liquid and more tradable. So it suits our investment style to invest in more liquid assets, and is less about the concerns about drawdowns. One thing I would say, though, and this is a lesson that I learned during the financial crisis back in 2008 and 2009, and was again very clear in 2020, is that when markets are weak and volatile, then liquidity is king. Your ability to be able to raise assets if you need to, but also take advantage of opportunities when they come along is crucial to adding value. If your portfolio is not liquid, then you cannot take advantage of that. And if in the period like we had in March this year, if you're faced with redemptions, but your fund is full of illiquid assets, it becomes very, very difficult to raise cash. So I think, just the lessons I've learned from times of crisis is that liquidity, cannot be underestimated as to how important that is. So there's a number of reasons as to why we take that approach.
Mm-hmm. So on this note, let's dive deeper into the current portfolio you and Alexander have built up. What do you think makes the fund unique, first stands out compared to its peers or compared to other products of same kind on the market?
Yeah, I would say things that I would say are different from what we do, maybe hopefully stand out, is that we focus solely on fixed income related assets. So we'll only invest in bonds or any fixed income related derivatives and nothing else. So that decision that we've taken to not take foreign currency risk, I think is something that will stand out relative to a number of funds in the peer group. The other thing is our approach in terms of the construction of the portfolio, that the portfolio is slightly more concentrated in the number of holdings that we'll have in the portfolio. And you can actually see that if you look on to slide number 7. Apologies for jumping around. You can see on slide 7 here of the presentation, the number of holdings in the portfolio is around about 130 bonds within the fund, which is a lot less than you'd find for other similar products on average, and much less than some of the very, very big sort of oil tanker funds that maybe have 400, 500, 600, 700 or even over 1,000 bonds in there. So it is a more concentrated approach, and that just comes back to our preference to add value through bottom up stock selection. And the final thing I would say is our willingness to be dynamic in terms of our allocation. And again, to jump back onto page 5 of the presentation, you can see there that our willingness to change the allocation in the fund is something that I think marks us out, because it could be very easy to have quite a static allocation where you always have 40% in high yield, or you always have 40% in government bonds and it never changes. We think is more appropriate to be more active in terms of how you move your allocation around. So I think there are some of the things that would be different from what you might see from other similar products.
Mm-hmm. So from your experience over the last years, where did the majority of active performance come from? Which sector have done particularly well and which didn't? Could you give us some examples?
Yeah, sure. What I can say, if you jump onto page 8, so I'm going to look on the next 8 and 9 of the presentation. I'll start on page 8. So if you were to look back over the last sort of few years, but in particular over the last 12 months, which I think is particularly relevant, there were 2 main areas I think which really benefited the portfolio in terms of how we run it. The first one is our willingness to be active in terms of our interest rate risk and duration within the portfolio. So what this chart shows here is the level of interest rate risk in the fund, which is the blue line. And then the individual coloured bars is where our duration risk came from over time. And you can see here that our willingness to increase interest rate risk through 2019 and into 2020 was beneficial to the fund as yields were falling quite substantially over that period. So you can see that having been close to 2 years worth of duration, it went up to about 8. So we've got a willingness to add that interest rate risk, and then identify markets where the opportunities were better. So in the US market in particular, but then also in places like Australia, Sweden, and other Scandinavian countries as well, and New Zealand, which were markets where there was really good opportunity in terms of adding exposure to government bond markets where central banks were very active, where asset purchase schemes were large, or where rate cuts were very aggressive and more so than the market had expected. And that was an area where we benefited from over the course of 2020, for example, by maintaining that level of interest rate risk for most of the year until November, when the announcements came about the vaccines, and then we reduced our interest rate risk accordingly. The second area would have been within our asset allocation and our exposure on the credit side or the corporate bond side. So if you look on the next page, on page 9 of the presentation, what this is showing here is how we manage the amount of credit risk within the portfolio. The blue bars here show our allocation to investment grade corporate bonds, and then the yellow is our exposure to the high yield market. And if I direct you to look at the bars on the high yield side, and what that shows is that having entered 2020 with a very low level of credit risk, so almost no allocation to the high yield market, we were then able to increase that exposure as the market was starting to weaken over the course of February and in particular March of 2020. We were able to add credit risk as the market was moving wider, so that when we reached the bottom and the market turned, which was around the 23rd of March, we had a much higher level of credit risk in the fund than we had at the start of the year, and we're well positioned to benefit from the rally or the recovery that came following that. Within that exposure, we were also taking advantage of very attractive opportunities in the investment grade credit market. So a number of very good quality companies issued new bonds into the US dollar corporate bond market. Names such as Walmart, Microsoft, Dell, McDonald's, JP Morgan, all issued bonds at very, very attractive levels and at the very long end of the curve. So we took the opportunity to allocate more into those opportunities, because these were assets coming at a very cheap level relative to credit risk you were taking. And you're almost able to increase the yield on your fund without actually taking any more credit risk. If anything, you're maybe reducing your credit profile if you're switching out of the high yield market. And that was an opportunity to take advantage of that. And then that sort of played out. And then we had an opportunity to look more at cyclical names within the investment grade space. So these were things that were affected by the COVID-19 crisis that had maybe underperformed. So airline manufacturers like Boeing, we added into the portfolio, and then things like Ford and GM, which are sort of on the cusp between investment grade and and high yield. The final decision that we took, which I think was quite relevant, is the decision to reduce our credit risk as we entered the end of the year. So you can see these colored bars are starting to reduce as we entered 2021. So that ability to move that asset allocation around, I think, was crucial. But then within that, the opportunity to add value through stock selection was also key. So the bonds that you pick are crucial to delivering returns. 2020 may have been a year where asset allocation and duration were important, but the difference between an average performing fund and an above average performing fund was more about the bonds that you bought and the individual sectors that you invested in. And that was something that we very much looked to take advantage of. And we were fortunate enough, if you see on page 10 of the presentation, that we can see that was borne out in the performance of the fund, both over the shorter term and over the longer term. So I guess in terms of examples of of things that we do, it all comes back to making use of the different alpha sources we have, the 6 sources of alpha. So the combination of asset allocation, duration, and yield curve, managing credit risk, sector exposure, and then bottom up stock selection. We're making use of all of these to help deliver returns, and making sure that we're not limiting ourselves in terms of only top-down ideas or only bottom-up. And rotating between them is something we felt has been beneficial for us over the last 3 years or so.
So, as you mentioned, like a Play-Doh, how do you size the position in the portfolio, given that the fund is benchmark agnostic? What is for example, maximum cash position allowed for the portfolio?
Yeah, that's a good question. I'll answer that final question first. Actually, we don't necessarily see cash as as an investment tool. So we try where possible to be as fully invested as we can, acknowledging that there will be times where you might temporarily take profit on a position and that and you might move that into cash before you recycle into something else. So the maximum that we'd be comfortable having would be certainly no more than 10% in the fund at any time. But on average, it's probably less than 5% that we would have within the fund. In terms of the sizing of positions, um, I think it's a real benefit to not be constrained by a benchmark. So we don't have an index, so that gives us much more flexibility to invest in the way we think is appropriate. But I guess there's a couple of crucial things within that. This isn't a fund that looks to maximize risk, at all times. We have to consider, risk and return and balance out those opportunities. So one of the constraints we have in the fund is that we won't have more than 40% of the fund's assets invested in the high yield market at any one time. So there is a limit there as to how much we'll invest into high yield. The reason for that is if we take a portfolio like this and you invest more than 40% into the high yield market, it then starts to dominate both the risk and return profile of the portfolio. Whereas what we're looking to do is have a more diversified range of opportunities within the fund so that we can give people access to like a sort of broad-based set of fixed income based risks and returns and not be dominated by a single asset class. But when we're looking to determine how much we want to allocate into an individual sector, so be that investment grade corporate bonds, or how much we want to have in financials or banks, for example, and whichever it may be, for us what we're looking at is the the risk adjusted return potential of each individual opportunity. So we're looking to have an implicit return forecast that we have for our investment horizon, and then you have to risk adjust that to determine which is appropriate to invest in. So if we think markets are going to trade well from a risky assets point of view, then we can look to see whether are you better to exploit that through high yield or through investment grade corporate bonds, knowing that you can't, you can 1 unit of risk on high yield is usually the same as 4 units of risk on investment grade. So you have to kind of size all your positions appropriately. And then the final factor when we're looking at individual stock positions and how we size them is there's two key factors. One is the conviction in the position or the return expectation, and the other one is the risk. So in very basic terms, the more risky the position, then the smaller the size that we will have. So your average holding position in a high yield company will be smaller than on our investment grade side. So it's very much kind of sized on that basis. So it's an element of the conviction that we have in the trade. The higher the conviction, the higher the position. But then, of course, the risk or volatility of that individual position will then lead to how large a position you're comfortable having within the fund. What we're really looking to do is have a number of positions and a lot of things going on within the fund and not be driven by one single idea or one single position, because it is an overall portfolio that we're looking at. So the decision to have more credit risk in the fund can also then inform how much interest rate risk you want to have as well. So an example from last year would be that we were very bullish on having credit risk in the fund. So we had our maximum allocation into high yield. On the other side, we thought it was appropriate to have a higher level of duration in the fund to balance out some of that risk in case we were wrong. If the recovery reversed and if the vaccine hadn't been announced in November and there was concerns about the second wave of the virus, then that large position that we had in credit risk would start to hurt the fund. But then if you've got the balance of more interest rate risk, then it gives you the opportunity to balance out some of the risk that you might be taking. So you have to look at everything in an overall portfolio context and try not to just have one single idea or one single position that drives all of the returns in your fund. And that's crucial in terms of balancing out the risk and protecting to the downside.
So as you talked about risk management, what do you think about the overall risk of for the portfolio? Are there any additional measures taken to protect downside or to combine your downside protection with conviction investing and control the volatility simply?
Yeah, no, and I think that is the important. I think you've really touched on what I think is an important function that these types of portfolios can play, and that is this is not just all about chasing the upside in fixed income markets. This is a long only fund. This isn't an absolute return fund. So we're always in the market. We're always going to be influenced by market beta and market direction. But what we can do is, tilt the portfolio to be either benefit more from the upside, so have more of a pro risk stance, and that can be expressed through our asset allocation. But then we can also be more defensive in the fund. So we can and do make use of credit default swap indices or CDS indices, which we can use to reduce the level of beta within the portfolio, the amount of market risk that you were exposed to. And what that can do is it reduces the amount of downside risk that you have in the fund. You can't completely remove it. As I say, this isn't an absolute return portfolio, but you can meaningfully reduce your exposure, which was something that we benefited from in the early part of 2020. Where we're positioned today is we've actually made use of those CDS indices to hedge out about half of the credit risk in the fund. So about half of our high yield allocation has been hedged out, and about half of our investment grade allocation as well.
Okay.
And that's because we feel markets are expensive. Markets, have moved a long way. There's a lot of reasons to be optimistic. Central bank buying, as you mentioned at the start of the call, government spending and fiscal spending, all very supportive. Valuations have got quite expensive. So what we can do is we can reduce our exposure to the market or the level of beta in the fund by using these CDS indices. But crucially, it allows us to retain the individual bonds that we've selected in the fund that we've bought for a reason and that we're quite happy to hold. So I think it's important to be able to take advantage of upside opportunities when they come, but crucially manage that downside risk where we think that is appropriate. And similarly, we can do the same with our exposure to interest rate risk. The range we have is between 0 and 10 years worth of duration, not negative. I fundamentally disagree with having negative duration within a portfolio such as this. And instead, it will always be net long, so it'll have positive interest rate risk, but we have a wide range that we can play within so that we can be very defensive and have a high level of duration, or a much lower level if we think that government bond yields are going to move materially higher. So we've got a number of different levers we can pull on in terms of the overall level of risk, but also the different asset classes we can invest in. So one of the current concerns on the market would be about inflation, which we don't think is anything we should be too concerned about. But if that is a concern, then through altering your interest rate risk, buying inflation-linked securities, investing in the high-yield market, buying bank debt, all of these things tend to do well in an inflationary environment. So we can protect against the biggest fear that bond investors have, which is higher inflation. But there's lots of things that we can do to still add value in that type of environment.
Great. So as always, let's wrap up the meeting with your take on the bond market outlook in general. I believe you covered a little bit just now. Looking back, government bonds was actually an unattractive asset, especially for developed markets. We're talking where yields are low and prices are expensive. Many investors are now looking elsewhere into the emerging market for better yields. So countries like China, for example, are on faster track of recovery. Would you consider emerging market credit in your portfolio, and why not?
Yeah, of course. Emerging markets is a part of our investable universe, and we look at it very closely. Part of the problem right now with investing in emerging market debt, to your point, China is in a much, much better place in terms of its economic recovery and how far through it's got through this cycle and how it's emerged from the from this crisis.
Mhm.
The problem we have there is that many companies and many sovereigns that benefit from the recovery in China, their assets are already priced to reflect that. So they're already quite expensive,
Mhm.
much like we're seeing in parts of the developed markets where they're already pricing a lot of good news. So I absolutely agree that that any country that has export links into China, fantastic place to invest in terms of there's a lot of potential upside for an economic growth standpoint, but from an asset value standpoint, then those parts of the market are already fully valued in our eyes, and therefore the opportunity for upside isn't great. The downside is probably quite limited, but the upside is a little bit more contained, which then means you have to take a step back and look elsewhere. And then if you look in sort of Latin America and sort of South America as another big part of the EM universe, I think that they're not quite as far through this crisis as they are in Asia, and there's still a number of risks at a sort of very sort of top-down level in many of these economies, particularly places like Brazil, which I think is facing some challenges. So what we're focusing on instead is more sort of bottom-up individual company stories or individual sort of sovereign names that we think can still add some value. So one that we'd have in the fund, it's not the most exciting name in the world, but we've got exposure to Pemex in the fund. So Mexico is actually in quite a good place in terms of where it is coming out of this crisis, and the recovery in commodity prices will again be something that would be beneficial in Mexico. And Pemex bonds are pretty much guaranteed by the government and trade at a very cheap level compared to the Mexican sovereign. So again, that's a type of exposure that we'd be happy to take. And then elsewhere, we're looking at just the individual stock stories that fall within that EM universe, as opposed to looking to make a big asset allocation shift out of developed markets and into emerging markets at this time.
Okay. So on a macro view, companies raised 2.5 trillion US dollars of bonds in the US alone, of a record breaking last year. So we all know that central banks are not always going to be there and to backstop the market. But would you think would these borrowing binge because of the low cost and easier financing continue this year? And what kind of tantrum are we expecting when market gradually pulls away policy accommodation?
Yeah, and I think that is the other big fear of a fixed income investor, is some form of policy error and some form of early tapering of asset purchases, causing some sort of taper tantrum like we saw back in 2013. Last year was, I won't say it was a unique year from an issuance point of view, but it is a year that is unlikely to be repeated anytime soon in terms of the amount of debt that was issued within the corporate bond market.
Mhm.
What that means is that for a lot of these companies, they will have termed out much of their debt for the next, 2, 3, 5 years, which means there's not the same need to raise debt again, in 2021 or maybe even 2022. So it's very unlikely that you're going to see the degree of issuance coming to the market as we saw last year, which is probably a good thing because, as I mentioned, valuations are quite stretched, spreads are quite low, yields are low as well. Therefore, hitting investors with more bonds than they really want wouldn't be very helpful. So I think there may be a little bit of stabilization between the supply and demand this year. But crucially, the central bank plays a big role in this.
Mhm.
We don't see a major risk of central banks tapering or upsetting the bond market during the next 12 months. I think it maybe starts to become more of a risk when we start to look into 2022 and beyond. The reason for that is that, as I mentioned, inflation has been low. We don't see necessarily that it's going to rise to the point where it's going to make central banks nervous. Economic growth is undoubtedly going to recover, but there is a huge amount of spare capacity that has to be worked through. So if you imagine that during the pandemic, it's almost like a huge hole has been dug in the global economy that, as growth sort of collapsed.
Yeah.
And we need to climb out of that hole before we can even start thinking about growing at above the same level we were in 2019. So there's a lot that has to be done before we're going to reach a level where growth is going to trouble central banks. And they made it very clear, whereas the ECB or the Federal Reserve at their recent meetings, that rate hikes are some way down the line, and they're not looking to make that change anytime soon. And I think they're likely to err on the side of caution rather than removing that stimulus too soon. But don't get me wrong, that is the biggest risk that we face this year, would be a fear that central banks, particularly the ECB or the Federal Reserve, were going to remove that stimulus before the market is ready for it. We don't think that's the case. We think that they're going to be much more slow and steady, more cautious, and will raise rates ultimately at a very slow level. But I don't see the ingredients for that happening this year. And for that reason, the fixed income markets in general will still have that strong backstop and support, which means that from here, the upside, there is still some upside, but it's not huge. But the downside isn't as large as many people fear. The difficulty as a fixed income investor is, if the beta in the market has got us to where we are today, then you need to find other ways to add value, and that's where the focus on alpha becomes more important. The decision on which bonds to hold and which sectors to invest in is going to be the crucial determinant on how bond funds will perform in 2021, and that's where the different opportunities and flexibilities really add value for clients.
Thank you, Colin. I think first, thank you for the brilliant presentation. We talk about the Aegon Global Strategic Bond Fund today. The flexibility of a strategic bond fund actually enables investment across a wide range of fixed income investments, allowing the manager like you to be more reactive to the macro environment and make decisions without the constraints of more like traditional bond funds. Unfortunately, we have to stop here in the interest of time. Hope you all enjoyed today's webinar, and we wish you a good start of the week. And see you next time. Thanks, Colin.
Thank you. Thanks for your time.